It's my honor and privilege to introduce today our very own Dr. Lawrence Yun. He is the Chief Economist and Senior Vice President of Research at the NAR. He oversees and is responsible for a wide range of research activity for the association, including NAR's existing home sales statistics, Affordability Index, Home Buyers and Sellers Profile Report. He regularly provides commentary on real estate market for our 1.4 million members. Dr. Yun creates NAR's forecasts and participates in many economic forecasting panels, among them the Blue Chip Council and the Wall Street Journal Forecasting Survey. He appears regularly on financial news outlets and is a frequent speaker at real estate conferences throughout the United States. He's testified before Congress. He also participates in the Industrial Economists Discussion Group at the Joint Center for Housing Studies at Harvard University, and he's appeared as guest on C-SPAN's Washington's Journal. Dr. Yun has received his undergraduate degree from Purdue University and earned his PhD from the University of Maryland at College Park. And speaking personally for me, it's always been a blessing, and we've been fortunate to have such a smart person to be able to take this information and make it in a communication format that we regular folks can understand. So without further ado, I'd like to introduce Dr. Lawrence Yun. Lawrence, take it away.
Thank you, Bob, for inviting me and for the introduction. Good morning, everyone. So I am here based in Arlington, Virginia. We are getting our first snow of the year, but it's expected to melt away by by 5 p.m., I believe. So guys, this is our weather. In fact, one of the big surprises for any people from Minnesota coming to the DC area is we get snow once a year, at least once a year. But anytime it comes, it surprises everyone. Many people don't have a snow scraper of for the windshield wiping. So they use their credit card trying to wipe off snow or ice. So anyway, I hope you're all staying warm in the very cold state of Minnesota, but the real estate has certainly not been cold. It's been super hot, quite a surprise in 2020. If we remember the early months of the lockdown back in March, April, quite scary about the nature of the virus. We have seen the devastating consequence of the virus, just going across the country. But at least we have better understanding in terms of social distancing, mask on. We can show homes much in a safe way, far safer than visiting grocery stores. And people are taking opportunity of this safe purchasing opportunity in real estate, along with the fact that record low mortgage rates have clearly helped. So of all the surprises, at least related to the economy, is that real estate has clearly outperformed, exceeding anyone's expectation when the pandemic first hit. Let me put the screen onto, my slides onto the screen as I speak better with the PowerPoint slides. So bear with me. All right, so this is the job market in the US over the past 20 years. That slight little hump that you see at the beginning, around 2005, in hindsight, that was an artificial job creation led by the subprime lending. Easy loans, easy mortgages. Home building activity was very robust at that time. But in hindsight, mortgages imploded because it overstretched people's budget, adjustable rate mortgages, and we had a foreclosure crisis. But from the low point in 2010, America experienced the longest economic expansion ever. President Obama, President Trump, all the way 10 straight years of job creation, amazing economic performance. Then in a single month of April, we lost all that jobs. 10 years of gain gone in a single month because of the lockdown. But as the economy steadily reopened, you see that jobs are coming around, but we are essentially halfway there. We need another 9.8 million jobs to get us back to the prior peak level. This is on a nationwide data. If we look at the Minneapolis, the pattern is very, very similar to the US. So you see that little hump, and then foreclosure crisis, 10 straight years of job creation, lockdown, and the recovery. So in the greater Minneapolis, St. Paul, Bloomington region, it looks like the following. But if we look at outside of the Minneapolis region, the rest of Minnesota, what one finds is that the job growth has been more slower compared to the city. So if you're looking at, where's the job creation in the state of Minnesota, it's primarily in the Minneapolis, St. Paul, more light job creation. And then there was a lockdown. Now there's a little recovery from it. But overall, if you look at the state overall, it's a very, very large state, but it's principally in the Minneapolis region where the most of the action had been prior to the pandemic. And we'll see what happens as we go into the future. State by state variation looks like this. Minnesota down 6.3%, which is about national average. The nearby state of North Dakota, because of the oil price collapse, they're down. And the Wisconsin, you see something similar. But there is a variation, especially among the southern states. If you look at the southern states, job declines are much more modest. So what is the driving factor for this? And one big criteria is that the governors in southern states decided to reopen its economy sooner and in a more relaxing way, while the northern states tends to be more restrictive and longer lockdown, and hence the variation in the jobs. But then you can say, well, in New York, at least it appears to have contained the virus much better than, say, in Texas or Florida. But this is the big trade-off that many governors are facing. Do you try to contain the virus with a stricter lockdown, or do you say to the people, go about your business, please be careful, social distancing, because we have to get the economy going along with it as well. If we look at the recent job creation, month-to-month job numbers, April, big decline, then some job creation, but look at October and November. Is barely showing up in the radar, which is implying that we truly need another stimulus measure. Get the money out to the unemployed people. We're really pushing for rental subsidy. It should not be simply eviction moratorium without the small landlords. They're out of the money. How do the landlords pay their mortgage? So we are really pushing for the rental subsidy into the stimulus measure and for small business loans. But one sticking point on the stimulus package, and I know they're in the deep discussion trying to pass something, is going back to the US map. So what this is showing is that like California and New York, they have very high unemployment rate. And Mitch McConnell is in essence saying that why should the governors of New York and California benefit from next round of stimulus when they did not reopen the economy? So, this is the one sticking point as to how they were trying to design the right size of the stimulus. Related to the overall income situation, so the economy is down, but income right now is higher compared to 1 year ago. It's coming down a bit from the second quarter because second quarter there was that $1,200 stimulus check, but now it is beginning to fade away. But it is still up from 1 year ago because of the massive stimulus, including the enhanced unemployment benefits that was in place. And I appreciate all the help from Bob and the rest of the important people from Minnesota in trying to push the legislation at the earlier part of the pandemic to say realtors should qualify for unemployment insurance. Businesses were disrupted. It's not the fault of the realtors as to why there are no activity. And therefore, during the disrupted months, that should qualify for unemployment insurance. Unfortunately, now many people are doing home sales and getting the income with the economic activity, but it was critical in the first few months of that time. What are people doing with this extra income? They're not spending it all. So savings rate is much higher. Because if you cannot go see the Vikings play in person, go to the restaurant comfortably, what you have is that people are saving up their money, which hints at once the vaccine is widely distributed, and we know the vaccine distribution is just around the corner, there could be some unleashing of this savings back into the economy. Now, this is the national average. I understand there are some families really struggling paycheck to paycheck. They have depleted their savings. But nationwide, we have higher than normal savings. And once the economy reopens with a vaccine, there could be unleashing of all this spending back into the economy. Now let's go turn to the great news, home sales. So look at the home sales activity, that U-shaped down, but when it reopened, and thankfully realtors are following those social distancing measures, private appointment to get the comfort level for both buyers and sellers, and home sales are recovering and then some. Recent months activity is actually better than 1 year ago. So really surging in terms of home sales. New home sales, similar picture. It is up about 40% up from 1 year ago. So home builders, you build it, you can easily sell your property and make money. So builders doing very well in the current environment. And the pending contracts are up about 20%, implying that winter closing activity for home sales, this could be one of the best winter ever based on the pending contracts activity. We have to compare apple to apple, winter to other winters, because we cannot compare to spring buying season, but this winter will be one of the better winter months activity for home sales. What do realtors say to their clients to demonstrate seriousness? Get a mortgage. So what are ordinary people doing? They are applying for mortgages, mortgage application to buy a home, excluding refinance, not including refinance, only to buy a home. It is up 30% from 1 year ago, which is implying that spring buying season could also be very active. People are in the pipeline, ready to hit the marketplace. Maybe they do the pending contracts in January, February, and the closing happening in March, April period, very, very strong. Let me focus your attention now to that first arrow, red line arrow that you see, slightly downward trend. So in 2018, mortgage application declined modestly, not anything major, but at least it declined. Let me go back. Pending contracts in 2018 declined. Home builder activity declined in 2018. Closing activity, home sales declined in 2018. So what was happening in 2018? Wasn't that part of that 10 years of the job creation, the longest economic expansion ever? And answer is yes, jobs were being added to the economy, but what was happening in 2018 is that mortgage rate shot up from 4% from the beginning of the year to 5%. So this shows how sensitive the housing sector is to changes in mortgage rates. You can have a great economy, but if the mortgage rate rise, it's gonna choke up some buyers. The reason why the buyers are surging right now is we are at a record low mortgage rate of under 3%. And that is the key reason that in the midst of the pandemic, in the midst of a high unemployment rate condition, those with secure employment are saying mortgage rates are too good, I am going to take advantage. The buyer activity is surging. Because of the strong buyers, home prices are rising, record high in just about every location across the country. And the top line shows the housing asset valuation, all-time high. But note the bottom line, which is the total mortgage balance. It is not rising, which means that housing wealth continues to increase. So very good news for homeowners. Some people say right now we are in a K-shaped recovery. So that is to say, some people are doing well during the pandemic, other people are faltering. So people who have lost jobs and depleting savings, difficult situation. But one of the winners are homeowners. They are seeing their home values rise and building equity. But what is the one constraining factor for real estate at the moment? And what I have been hearing consistently from realtors across Minnesota is lack of inventory. If they had more inventory, they can get more home sales done. I mean, we are very fortunate. We are seeing very robust home sales activity, but it could be even higher if we had more inventory. So are we going to get any inventory help in 2021 next year? And the answer is not really, at least in the first half of the year. Maybe in the second half of the year, we will get some help. And how do I know that? This is housing start, new home construction. New home construction is the catalyst for more inventory. Often, new homes are larger, more expensive. It's not for the first-time buyers. It's generally for the trade-up buyers. But by producing new home, people trade up. But in the process of trading up, they release their current existing homes onto the market, and that's how we get more inventory. So we need more active building activity, and the builders have been underproducing for 10 straight years. Cumulative effect of underproduction for 10 years is that we simply don't have enough homes for sale. So hopefully the builders can go above that orange line comfortably to make up for some housing shortage. That orange line is the historical average. So the builders have been underproducing for quite some time. Some of the constraining factor for the builders is that lumber prices have essentially tripled, or double, and that has hampered. So, one quick fix to this is, well, why don't we just bring in more Canadian lumber? Maybe, reduce the tariff or eliminate the tariffs on Canadian lumber so that builders can build more homes in Minneapolis, and by doing so, job creation in Minneapolis region. The prices have really risen, partly because of the wildfires out in the western states, but at least in the short term, maybe we can use Canadian lumber because builders are hampered by this huge increase in lumber prices. Now let me turn towards how the pandemic may have changed locational preference. First, we know that people who used to go to office are now working from home. We have to congratulate and admire all the frontline workers, healthcare workers, nurses, grocery store. They're out there working every day in person. Realtors as well, they're working in person. But office workers have the luxury to work from home, so the demand for office leasing has really fallen off. And also when we ask the realtors about their recent client, what is their locational preference? And dominant answer is the suburbs. Some people indicating rural area, maybe away from Minneapolis and more smaller towns, and away from city centers. So city centers generally should get about 1/3 of the preference, urban area near city centers, but it's down dramatically. Resort area, Minnesota, the LA Lakers used to be Minnesota Lakers or Minneapolis Lakers because you have so many lakes out in the state. But now consumers are saying, I want to have a lake home. Usually resort areas should have less than 10%. Now we are getting 13% interest. So there is a preference for away from city centers into the suburbs, smaller town, and into the resort area. Let me also show you some interesting data. The vacation counties that generally cater to second homes, are doing better than normal markets. Work from home can also mean work from vacation home. How would the boss know whether you are at home or at vacation home? Why should the boss care as long as you get the work done? So we have seen a great ramp up in the home sales in the vacation region. So maybe northern Minnesota, they will steadily benefit if this trend continue to develop. So forward-looking indicator, like pending contract, it is up 20% from a year ago. Mortgage applications up 30% from 1 year ago. Lockbox opening up 20% from a year ago. Buyer traffic up 32%. And mortgage rates are not going anywhere. It will remain at record lows. So these are all positive indicators about potential home buying demand as we go into 21. We just need more inventory to get even higher home sales than what we have been observing. So as we go into the forecast, the 2020, the middle column is a recession. Economy is down, we are losing jobs, but interest rates are low and we have no inflation. But as we go into 2021, with the vaccine availability, the economy will be growing, job creation coming along. Interest rate, the Federal Reserve has indicated they want to keep the interest rate low for a long period. And also President-elect Joe Biden, he is likely to appoint Federal Reserve governors who are more likely to keep interest rate low for a longer period. Therefore, at least the mortgage rate should be very low in 2021. As to the housing market, 2020, amazingly, even as we missed the spring buying season, home sales will be higher in 2020 versus last year because of such a strong second half. New home sales up 20% in 2020, existing home sales up about 3% once all the numbers are in. Prices up very positive, and even in 2021, the interest rate will be low, but we have home sales will be rising. I have a 9% growth, which means that the reality could be anywhere from 6 to 12% growth in home sales. So why a surge in home sales? Well, it's just continuation of the current pattern plus one additional factor, second order housing demand. This is where your past clients who have been very content with their home before the pandemic suddenly say, my 3-bedroom home is insufficient. I need a 4th bedroom to turn it into office space, or even 5th bedroom to turn it into office space for my spouse. So therefore, you will see this second order demand arising. And people may say, why am I living so close to the city center when I can be further away by a mansion at more affordable prices? So you may begin to see additional housing demand developing. So overall, very good condition for housing market. Just one little final thought on the President-elect Biden coming in. He has mentioned about the $15,000 home buyer tax credit, which would be available at the closing table, which in essence becomes a down payment assistance. How this it gets into legislation, Congress, compromise, and eventually becomes a law, it remains to be seen. So that's at least very positive that the Biden administration is considering looking at home ownership as the broad way to enlarge the middle class wealth building. But he also has mentioned about taking away 1031 exchange. So we will be in communication with the Biden camp about how important 1031 is for commercial real estate, but also for sale of a land to home builders. Many land sales are using 1031 exchange, and we don't want 1031 exchange to be removed and hinder supply because we need more supply. So the focus on home ownership rate is very good, but we also need the right policy so that we have a balanced supply and demand. So thank you again for listening, and thank you, Bob, for inviting me, and I'm going to turn it back over to Bob.
Well, you're welcome, Dr. Yoon. Really appreciate it. It's always fascinating. One thing I remember when I was in my real estate degree program at St. Cloud State is my Dr. Carvel told us if the interest rates went up 1%, it took about 1 million people out of the homeownership buying. Is that still true today?
Fortunately, the interest rate has fallen. So in a sense, you can say the opposite, that is enlarged by a little 1 million potential people who could become homeowners. I don't know what the exact number is. Is it 750,000 or is it a 1 million? But certainly the home ownership rate is negatively correlated with the interest rate. So the interest rates are falling. And some encouraging news. We have seen the home ownership rates rise along all categories. More so among the younger generation who have very low home ownership rate. Now they're getting some boost. And also among minority households, Hispanic households, African-American households. Now their home ownership rate is still way low, but we need to get it more opportunity and enlarge the possibility for a wider number of people. So we are seeing sort of bigger percentage gain boost among minority home ownership rates.
Perfect. There's also a question that's online here from Brad Griffith. And he's saying that the 2020 Real Estate Forecasting Summit, you mentioned you thought values would continue to rise in 2021 quarter one. And his question is, he's trying to wrap his head around the increasing prices during a recession. And are they just a matter of lack of inventory and low interest rates?
So it's counterintuitive. You know, when there is a recession, you know, the bad things should be occurring. And the last recession we had 10 years ago, it was housing-driven recession. Bad mortgages, builders produced way too many homes, oversupply, and the prices collapsed, and we had a foreclosure mess. This time around, we don't have those funny mortgages. All the mortgages are soundly underwritten. So people who are under distress is not due to mortgage, but due to loss of job. So hopefully with a vaccine, those jobs recovery can continue, and hopefully some stimulus measure, quick stimulus measure to get us over the soft patch. And the other one is we simply don't have enough homes for sale, and prices do not decline when we have lack of inventory. Let me give you one other example. September 11th event, the horrific events. So we had a recession in the US, but home prices actually rose. And you said, why did the home prices rise during that time? Because mortgage rate declined from 8% to 6%. So that stimulated the housing.
You're still on mute, Bob.
Are there any other questions that you're seeing?
I will check. I think we can just do a few more. Do you think prices may start declining in major cities? Is one of them?
I would say the major cities is the category of expensive cities. Home prices in Manhattan, or I should say condominium prices in Manhattan, is already coming down. People are fleeing Manhattan, and the suburbs, northern New Jersey, Connecticut, Long Island, they're doing well. I mean, people are coming out of the condominiums and they are buying single family homes. So single family homes out in the suburbs are rising strongly. Even the condominium prices in Manhattan is coming down. San Francisco so far is still holding on. I'm quite surprised. I thought maybe San Francisco prices will come down because those small size townhouses, $2 million. I mean, why live, pay that amount when one can go to Minnesota and buy a mansion? And some San Francisco companies like Twitter has announced to their employees, you can work from home forever. So why do they need to live so close to San Francisco if they can work from anywhere? And other companies will provide more work flexibility, maybe not that extreme, maybe come to office 2 days a week. Another 3 days you can work from home. And yeah, again, if that is the dynamics, why have to struggle through all those traffic jams when one can be further out in a smaller town and get a fresher air and larger house? I have time for one more question.
Perfect. Laura, do you want to pick from those?
Sure, I'll just do the one that was in order. How many homeowners are delinquent or behind on their mortgage payments? How will this affect the foreclosure market when the current legislation ends the eviction and foreclosure moratorium?
A very good question. So looking at the downside, currently the mortgage forbearance number is about 5%, meaning that 5% of the people with mortgages. I mean, there are some people who don't have mortgages. They own their home free and clear. But among those people with mortgages is 5%. 10% on FHA loans, less number on the other loans. So let's hope that people can find jobs sometime next year so they go out of the mortgage forbearance period. But my guess is that the Biden administration would be more sympathetic to extending that period from March 2021, which is the current ending period. So there could be some extension of that to give more time for the people to catch up. So that's a possibility, but let's say some people who really struggle and they cannot really catch up, they don't have a job. When it goes to the foreclosures, we never want to see that as a huge pain for the family. But in terms of the market, there are so many buyers, there will be easy strong demand to pick up those property quickly, so you will not have any negative impact on home prices.
Thank you so much, Dr. Yoon. We know you have another appointment. We wish you a happy holidays. We hope that next time we can see you live and in person here in Minnesota. Stay safe, and again, thank you for your efforts.
Thank you and happy holidays, everyone.